So usually when we talk about walking into a casino, there's this, immediate expectation of just pure chaotic chance.
Oh,
Like you picture the blinking lights, the roulette wheels, and that absolute certainty that the house holds all the cards. You basically just put your money down and hope today is your lucky day.
right, because it's an environment engineered to be completely out of your control. I mean, it's thrilling, sure, but ultimately it's a systemic gamble.
Exactly. But then you step into the world of the stock market, and for millions of everyday investors, it feels like the exact same room.
Yeah, it really does.
It feels like this high-stakes casino where blind luck or, I don't know, maybe some secretive insider tip is the only way to win. And we're looking at a financial landscape that is incredibly intimidating,
Mm,
especially if you've ever watched your portfolio just swing wildly on a single news headline.
right, it's the absolute definition of a perceived chaotic system. A lot of people operate under this assumption that you either have to be like a psychic predicting macroeconomic future, or you just blindly throw money at a broad index fund and hope inflation doesn't eat your returns over 30 years.
Yeah, but what if it's not a casino at all?
Yeah.
What if behind those, blinking red and green numbers on your screen, there's an actual blueprint? So
Hmm.
today, for you listening, we're on a mission. We are going to transform your view of the stock market from this chaotic, high-stakes gamble into a predictable, data-driven, repeatable process.
A total paradigm shift, really.
Exactly. And we have an incredible stack of sources for this deep dive today, centered around William J. O'Neill's legendary book, How to Make Money in Stocks, and a comprehensive analysis suite breaking down his famous CAN-SLIM system.
Yeah, and the foundation of O'Neill's work is really what makes this deep dive so compelling, because he didn't just sit in some ivory tower and theorize about what should theoretically make a stock go up.
Right. No guesswork.
Exactly. He and his team conducted this exhaustive empirical historical study. I mean, they went back through decades of
Yeah.
physical ticker tape. Yeah, microfiche, historical financial records, and they isolated the 1,000 biggest stock market winners dating all the way back to the 1880s.
The 1880s, that's insane.
Right. He wanted to reverse engineer the DNA of a monster stock.
Right.
So he looked at what all these massive winners had in common in the months right before they made their giant price leaps.
And it turns out it's not magic, but it's entirely measurable. So we invite you to just sit back, relax, and basically be the third person in this conversation
Yeah,
as we decode that DNA.
let's do it.
We want to arm you with a 100-year data-tested framework so you can navigate these markets without the anxiety of, information overload.
Yeah.
So let's look at the raw material first. If we're reverse engineering these historical monsters, what's the core engine? Like, what did O'Neill find at the absolute center of every massive breakout?
Unprecedented fundamental acceleration, period.
Okay.
Specifically, we're talking about current quarterly earnings and annual earnings. So in the CAN-SLIM acronym, this is the C and the A.
Right, the first two letters.
Right. So O'Neill's data showed that for a stock to have a real chance of being a market leader, its latest quarterly earnings per share must be up significantly compared to the exact same quarter of the previous year.
Like, how significantly?
A minimum of 25% growth is the baseline.
Okay.
But the real generational winners, the monsters, they're showing 50%, 100%, or even like 200% current quarterly growth.
Wait, hold on. So if I'm reading a financial news site and a tech company's, I don't know, headline profit is up 60%, am I just golden? Because I've definitely seen stocks tank immediately after reporting those kinds of massive numbers.
Yeah, and that happens because those top-line headline numbers are often an illusion.
Oh, really?
Yeah, the sources really emphasize that you have to strip out one-time extraordinary gains.
Okay, what does that mean in practice?
Well, imagine a computer manufacturer reports a 60% profit increase, right? But half of that profit actually came from selling off a massive piece of corporate real estate.
Oh, I see.
Right, so their actual core business isn't accelerating at all. They just sold a building. You have to subtract those non-recurring profits to find the genuine operational business growth.
Okay, yeah, that makes total sense. We're looking for the actual machine working better, not just some one-off windfall.
Exactly. And that genuine operational growth leads right into the A annual earnings.
Okay.
Because, a single spectacular quarter could just be a seasonal fluke.
Yeah.
To prove it's a sustainable enterprise that major institutions will actually want to own, you have to look for a consistent track record.
Over how long?
The data says you want annual earnings growing 25% to 50% or more each year over the last 3 to 5 years.
Oh, wow. That's rigorous.
It is, but that proves the business model is highly scalable.
Okay, let's unpack this for a second. We have a solid engine, right? A proven 3-year track record, great current quarters. But, I mean, I know plenty of massive blue chip companies that just hum along with great earnings, and their stock price basically flatlines for a decade.
Oh, totally. A great company definitely doesn't automatically mean a surging stock.
Right, so what actually lights the match? Like, what makes the price explode?
Well, that catalyst is the N, which stands for new.
Okay.
A company needs a revolutionary spark. So that could be a game-changing new product, incredibly disruptive new management, or even just a massive structural shift in their industry.
Okay, do the sources give a good example of that?
Yeah, they highlight this stunning example from 1963 with a pharmaceutical company called Syntex.
Okay.
They introduced the oral contraceptive pill-like,
Hmm.
an entirely new product that quite literally changed society.
I imagine the market reacted pretty violently to that.
Oh, it did. But the critical technical component regarding the N factor is how it manifests on a chart.
Right, the actual price action.
Exactly. Because before Syntex went on its historical run, the stock was emerging from this period of consolidation and hitting a brand new price high of $100 a share.
Wow, $100 back then.
Right, and most investors looked at that $100 price tag, thought it was way too expensive, and just stayed away.
Of course.
But from that quote-unquote expensive new high, it rocketed 400% in just 6 months. And we saw the exact same pattern when McDonald's introduced fast food franchising, or when Rexall introduced the Tupperware division.
See, I'm struggling with this specific point
How else?
because literally everything ingrained in investing culture, from, Warren Buffett to basic value investing maxims, it all tells us to find a bargain.
Right, the whole buy low, sell high thing.
Yeah. It's like shopping for a used car. You want a deal. But you're telling me that buying a stock at a 52-week high when it looks the absolute most expensive is the optimal move?
I am.
That just feels incredibly dangerous. Like buying a ticket to a movie that's already ending.
Well, what's fascinating here is what O'Neill calls the great paradox of the stock market.
Okay.
Because human intuition completely fails us here. The 100-year data proves that what seems too high and risky to the majority of people usually goes much higher.
And what seems low?
What seems low and cheap usually goes much lower.
Wow. So the cheap stock is actually the trap.
Exactly. It's the psychological trap of the contrarian optimist. People falsely equate a cheap share price with intrinsic value. But if you think about the actual mechanics, if a stock is trading at its 52-week low, there is almost always a severe fundamental reason why massive institutional investors are dumping it.
Like their earnings are probably falling apart.
Right, exactly. The earnings are deteriorating. Conversely, a stock hitting a new high is demonstrating immense market strength.
Because people are actually buying it.
Yeah, it means all those underlying fundamentals we talked about, the new products, the massive earnings growth, they're actively being validated by big money. You aren't arriving at the end of the movie, you're actually buying a ticket right as the plot twist is revealed and the real action begins.
That just completely flips the script on how we're taught to look at value. All right,
Yep.
so I'm buying the expensive, fundamentally explosive stock.
Yeah.
But, an engine in a vacuum doesn't go anywhere. Even the best company needs outside fuel to drive the price up. How do we know the market actually cares enough to move the needle?
Well, that requires analyzing market dynamics, which brings us to the next 3 components of the system: supply and demand, leader or laggard, and institutional sponsorship.
The S, L, and I.
Right. So the law of supply and demand dictates the price of literally everything in a capitalist system, and equities are no exception. The CAN-SLIM framework heavily favors small to mid-cap stocks.
Because there's less supply.
Exactly. The math is straightforward. A giant mature stock with, say, 3 billion shares outstanding takes a monumental, almost impossible amount of buying power to budge the price upward.
Right.
But a smaller entrepreneurial company with a limited supply of shares, a tiny influx of demand creates massive price velocity.
And the footprint of that demand is trading volume.
Right.
Like the sources say you're looking for a breakout accompanied by a massive 40% to 50% surge in average daily trading volume.
Yes. That volume surge is the physical footprint of big money stepping in, which ties directly into finding the true market leader, the L in the system.
Okay, tell me about the leader.
You only want to commit capital to the very best stock in the very best industry group. And to measure this objectively, O'Neill developed the relative strength, or RS rating.
How does that work?
You want a stock with an RS rating between 80 and 99, which means its price action is currently outperforming 80 to 99% of all other stocks in the entire market.
Okay, and the sources offer a really great warning here about sympathy stocks, because I see this happen all the time.
Oh, it's so common.
People miss the breakout on the true leader. Say they miss the massive run on NVIDIA or Apple, so they buy a third-tier, cheaper competitor thinking it has more, quote-unquote, room to grow.
It's a classic mistake.
Yeah, and the sources bring up 1970, when Levitt's Furniture was the absolute market leader. They basically pioneered massive warehouse discount centers, and their stock went up 900%.
900%.
Right. But then a company called Wix tried to copy them and become the cheaper sympathy play. People bought Wix because Levitt's felt too expensive.
And how did that work out?
Wix never caught up. They eventually went broke trying to mimic the true leader. So the leader gets the historic gains, and the laggard just destroys your portfolio.
And the historical data bears that out completely. In the market, the cheap alternative is almost always a trap.
Right.
To ensure you are in the true leader, you have to verify institutional sponsorship. That's the I.
Okay.
This is what they call the whale watch. You absolutely need massive mutual funds, pension funds, bank trusts, and insurance companies actively buying the stock.
Why are they so important?
Because they are the only entities mathematically capable of creating that massive 50% volume surge we just discussed.
Yeah.
They are the whales that actually controlled the board.
Okay, so what does this all mean for the everyday investor listening right now? Like, if we need these massive mutual funds to step in and drive the price, aren't we basically just at their mercy? It feels like we're on a tiny jet ski trying to navigate a harbor full of massive institutional battleships.
Well, if we connect this to the bigger picture, being on that jet ski is actually your ultimate structural advantage.
Really? How so?
O'Neill refers to this as the big cap handicap. Think about a mutual fund managing $50 billion, right?
Okay.
If they want to take a meaningful position in a small, highly explosive company, they cannot just buy it all on a Tuesday.
They would break the market.
Exactly. If they did, their own massive buying power would instantly spike the price, completely ruining their average cost. So they're forced to buy slowly over weeks or even months. And often they just stick to sluggish, giant cap companies simply because it's easier to maneuver their massive capital.
Ah, so the battleships literally take weeks to turn around.
Exactly. But you, on the jet ski, you can dart in and out of the most innovative, fast-growing companies in the world in milliseconds.
Yeah.
You do not move the market. But, and this is the critical discipline, you must wait for the battleships to start turning.
And you can't just guess.
Right. You wait for the whales to show up on those volume charts to confirm the trend before you commit a dime. You basically let the institutions do all the heavy lifting of driving the price, and you just ride safely in their slipstream.
Man, I love that visual. The agility of the individual investor isn't a weakness. It's actually their superpower.
Exactly.
But, even on a jet ski, if a Category 5 hurricane rolls in, you're going down.
Oh, for sure.
Even if you have the perfect stock, amazing quarterly earnings, game-changing new product, an RS rating of 99, and the mutual funds are buying it in droves, none of it matters if the macroeconomic environment is collapsing. We have to look at the broader market.
Right. And that's the final component, M, for market direction. It is the ultimate gatekeeper of the entire philosophy.
Okay.
Because historical precedent shows that 3 out of 4 stocks, 75% of all equities, will follow the broad market trend.
Wow, 75%.
Yeah. If the overall market goes into a steep, sustained decline, gravity just takes over. It will drag your perfect canned slim monster down with it.
Yeah, and the sources detail a very specific way to read this gravity. Like, they talk about spotting a market top using something called distribution days.
Yes, crucial concept.
And a distribution day occurs when a major index, like the S&P 500 or the NASDAQ, closes down in price on higher trading volume than the day before.
Correct.
But why does that specific combination of price and volume mean the sky is falling?
Well, think about the mechanics of how those institutional battleships have to sell. Like we said, they can't dump billions of dollars at once without crashing the price.
Right.
So they have to sell into strength. They quietly offload shares while retail investors are still enthusiastically buying.
Oh, sneaky.
Very. So when an index struggles to advance or closes down, but the volume of shares trading hands is suddenly massive, that is the physical footprint of heavyweights quietly liquidating under the surface.
And the rule is, if we see 4 or 5 of these distribution days clustered within a single month, the smart money's out. and we need to raise cash.
Precisely. And conversely, you spot a market bottom using what the system calls a follow-through day.
What does that look like?
This happens when a major index closes up 1.5% or more on significantly higher volume than the previous day, usually between the fourth and seventh day of an attempted market rally.
Okay, so that volume is key again.
Always. That surge in volume indicates the institutions are aggressively stepping back in, signaling a new bull market has likely begun.
Now, here's where it gets really interesting.
Yeah.
Because you're basically telling me to track daily market volume to gauge the health of the economy. But why wouldn't I just look at GDP numbers or jobs reports or what the Federal Reserve is doing with interest rates?
Right.
Like, why should I treat the market itself as the ultimate economic indicator rather than the actual economic data?
Yeah, because the market is a forward-looking mechanism, it quote-unquote discounts the future.
What do you mean by that?
It anticipates economic realities months before they show up in some delayed government report. The sources actually point to a classic example, the 1981 bear market.
Oh, okay.
It was triggered because the Federal Reserve raised discount rates to a staggering 14%.
14%.
Yeah, and the discount rate is the interest rate the Fed charges commercial banks. So when it hits 14%, borrowing money becomes impossibly expensive for businesses, completely choking corporate growth.
Obviously.
Right. But the stock market reacted to that mathematical reality and tanked long before the official economic data ever confirmed a recession.
Ah, so the market priced in the damage before the damage actually happened.
Exactly. Look at the 1962 market break as another example.
What happened then?
The underlying U.S. economy was perfectly fine, humming along, but the market tanked violently simply because the SEC announced major sweeping investigations into the financial sector. Yeah. So economic forecasts from talking heads, those are just opinions. The daily market averages, backed by institutional money, those are indisputable facts. You have to observe the market like a scientist observing fish in a bowl.
Right.
Just watch what the fish are actually doing.
Watch the fish, don't read a textbook about what the fish should be doing.
Yeah.
I love that.
Exactly.
Okay, so let's say the macro environment is in our favor. The market's in an uptrend. We found a fundamentally explosive stock.
Yeah.
What is the exact trigger to buy? Because the sources detail this golden chart pattern called the cup with handle.
Yeah.
Can you break down the mechanics and like the psychology of why this specific shape works?
Sure. So visually, it looks exactly like the profile of a teacup.
Literally a teacup.
Literally. The stock has been in a massive prior uptrend, but then the broad market corrects, or maybe the stock just needs a breather. The price drifts down and forms a wide U shape. That's the cup. The psychology of that U shape is vital. A gradual curve shakes out the weak, uncommitted investors. It wears them out over weeks or months of sideways, really boring action.
Right. They just get tired of waiting.
Exactly. Then, the stock eventually rallies back up near its old highs, but just before it breaks out into new territory, it pulls back slightly on very light trading volume for 1 to 4 weeks.
And that slight, quiet pullback is the handle.
You got it. That handle is the final, ultimate shakeout. It frustrates the very last remaining impatient holders into selling.
Just shaking the tree one last time.
Exactly. And once they throw their hands up and exit, there is almost no supply left holding the stock down.
Okay.
So the exact buy point, the pivot, is the top price of that handle. When the stock breaks above that specific price line on a 50% surge in volume, it is like a coiled spring releasing.
Oh.
All the weak hands are gone, the institutions are buying, and that is your precise low-risk entry.
Man, it's a beautiful visual of human psychology playing out in real-time supply and demand.
It really is.
But, human psychology brings us to the most difficult part of investing and kind of the final section of our deep dive, the art of the sell.
Ah, yeah.
Because the sources are incredibly firm on this. Finding the perfect stock and buying the perfect breakout is completely irrelevant if you don't master risk management.
Yeah.
All the real money is kept in the selling.
It is the absolute cornerstone of survival in the financial markets.
Yeah.
O'Neill's system relies on one unbreakable mathematical law, the 8% sell rule.
So it's just a hard, emotionless stop loss.
Exactly.
The second you buy a stock at that pivot point, you mentally place a stop 7% or 8% below your purchase price. If the stock drops to that level, you sell.
Yep.
No rationalizing, no checking Twitter to see if there's good news coming, no hoping it bounces back. You just cut it.
No questions asked. You are cutting your losses short before they can devastate your portfolio. And the system actually pairs this with a rule for taking profits, aiming for a 3-to-1 profit-to-loss ratio.
Okay, how does that balance out?
Well, if you are strictly limiting your risk to a maximum of 8% on the downside, the math dictates you should lock in profits when a stock reaches a 20% to 25% gain.
Wait, let me do the math on that 3-to-1 ratio for a second.
Sure.
If I'm taking profits at, say, 24% and cutting losses at a hard 8%, I could literally be completely wrong on half of my stock picks.
Exactly.
Like 50% of the companies I buy could be total duds.
Mhm.
But because the math is skewed 3-to-1, I still walk away incredibly profitable over time. It's exactly like batting .30 in professional baseball.
That's a great way to put it.
You fail to get a hit the vast majority of the time, but because the underlying math of the game rewards those hits, you still end up in the Hall of Fame.
Right. And this raises an important question, and it goes right to the heart of behavioral finance.
Okay.
If the math is that forgiving, why do so many people blow up their brokerage accounts? Because nobody likes to admit they were wrong. The 8% rule is not just about protecting your financial capital, it is primarily designed to protect your psychological capital.
Oh, that makes sense.
A small, normal pullback of 8% is a tiny paper cut. It won't ruin your life. But holding on to a sinking ship out of pride leads directly to the sunk cost fallacy.
Right, you just can't let go.
Exactly. You refuse to sell, the stock drops 50%, and suddenly you are paralyzed by a devastating loss that requires a 100% gain just to get back to zero.
And that perfectly highlights the two psychological profiles outlined in our analysis pack.
Yes.
The goal here is to transition from a dopamine-driven speculator to a process-driven pragmatist.
Right.
Because a speculator chases hot tips, right? They hold on to losers out of pure fear of realizing a loss. And they sell their winners way too early because they're desperate for the dopamine hit of securing a win.
It's all emotion.
Exactly.
Yeah.
But the pragmatist is emotionally detached. They view an 8% loss not as a personal failure, but just as a simple expected business expense.
And the pragmatist also utilizes strict rules for when to sell a winning stock.
Oh, okay, like when it goes up too fast.
Yes. Let's say you're up 50% on a canned slim leader. You don't just hold it forever out of greed. You watch for technical red flags, like what they call a climax top.
What does that look like?
This happens when a stock that has been trending steadily upward for months suddenly goes parabolic. It has explosive, rapid price increases day after day on record-breaking volume.
Like a feeding frenzy.
Exactly. The financial media is cheering it on. It looks like the greatest news in the world, but it is actually exhaustion. It is the last gasp of amateur late to the party buying right before the smart money unloads their massive positions.
And another major red flag mentioned is a stock breaking its 10-week moving average on heavy volume.
Yes.
Let's clarify that for a second. A moving average basically takes the closing price of the stock over the last 10 weeks and draws a smoothed out line on the chart to show the real trend, right? Stripping out the daily noise.
That's right.
So why is breaking that specific line a death sentence for a trade?
Because that 10-week line is the psychological and mathematical floor for institutional investors.
Okay.
If a stock has been riding above that line for months, it means the mutual funds are actively defending that price level. They're buying on the dips.
Right.
If the price slices violently down through that line on heavy volume, the trend is fundamentally broken. The institutions have abandoned their defense and are leaving the building.
Wow.
And you need to get to the exits too. Hope is a terrible investment strategy. Data, rules, and historical precedents, that is how you protect your capital.
Man, this has been absolutely eye-opening. So let's summarize the blueprint we've unpacked today.
Sure.
The canned slim system is not some magical crystal ball that predicts the future. It's a comprehensive operating manual.
Yes.
Our sources actually outline it as a 30-day mastery transformation plan. It demands that you combine fundamental acceleration, those massive quarterly and annual earnings, with technical chart reading, waiting for patterns like the cup with handle to shake out weak hands.
Right.
And it binds all of that together with ruthless, strict risk management, like the 8% sell rule.
And acting as the absolute governor over all of it, you must verify through volume analysis that the broad market is in a confirmed uptrend before committing your hard-earned money.
The M in canned slim.
Exactly. It is a complete transition from emotional gambling to calculated execution.
And for you listening right now, the biggest takeaway is empowerment. By utilizing a 100-year data-tested framework, You basically no longer need to feel overwhelmed by the constant deafening noise of Wall Street pundits or, chaotic internet forums.
Absolutely.
You can act decisively, you can confidently ignore the cheap laggards, let the battleships do the heavy lifting, and just sit back patiently, letting the true market leaders reveal themselves to you through the data.
It replaces anxiety with a repeatable process.
And it brings us right back to where we started. I want to leave you with a final thought to mull over. If the CAN-SLIM system proves that these massive, supposedly chaotic financial markets actually move based on strict, measurable patterns of human behavior and institutional momentum, what other complex areas of your life, your career trajectory, your business growth, or even your daily habits are you treating like a chaotic casino when they might actually follow a predictable data-driven code?
That's a great question.
Think about that the next time you feel like you're just spinning the roulette wheel. We'll catch you next time.